Okay, good morning and happy Friday, everyone. Welcome back to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we obviously have some big news this morning, and markets are reacting to that. So today, what we want to do is talk a little bit about how markets are reacting, what the reaction we have seen on the news that Donald Trump and the First Lady have tested positive for the coronavirus, what that means for the markets, and what do we expect going forward. So a lot to unpack here this morning, so let's go ahead and get started. Now, before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, before I get started, we have been getting a lot of questions over the past few weeks as to, what our expectations are for the market going forward. So we are going to be doing an election special next Friday morning. So instead of doing our normal Friday morning market outlook session, next Friday we're doing a members only special just for the election. We're going to talk about the different possible outcomes and what different industries are likely going to react in terms of the market to different possible outcomes of the election. Obviously, today's news this morning throws some of that into a spin in terms of what expectations are. Right now, it's still pretty early in the news cycle. We don't have a lot of news. Our expectation doesn't change a whole lot, other than the fact that we know that Donald Trump is going to have to cancel some events coming up in the next few weeks. Potentially the next debate is likely going to be canceled. So what impact does that have on the election, whether or not he gets symptoms and gets sick, and whether there's any transfer of power to Mike Pence? There are a lot of these things that are up in the air here over the next few days, next couple of weeks. So we're going to try to capture what we currently know and let you guys know next Friday. So please join us next Friday. If you don't have a membership, we'll show you how to access that here at the end. Today, what we're going to do is, as usual, we're going to start off with a brief market update. I will tell you that from the charts perspective, a lot of things kind of get thrown out the door with big news events like this. So what we wanted to look at is where have markets traded, where we will likely see going forward, and more likely what we really have to do is watch today's price action really closely to see how markets are reacting. We'll take a look at commodities and rates. We'll take a look at how other markets are reacting to this news. That provides also with us a little bit of a glimpse outside of just equities. And I want to take a look at employment and payrolls, which just came out again this morning, a little worse than expected, which compounded to the bad news that is driving markets a little further lower after the news overnight on Donald Trump. And then when we look at COVID and economic trends, we also start to see some worrying trends start to emerge. So we want to talk a little about what negative news do we see, what potential positives do we see on the horizon, and share with you some of our ideas. Like I said, there's going to be a lot of things in flux here over the next couple of trading days. So things you have to make sure that you stay on your toes. And at the very end, if we have a few minutes, we'll open this up for Q&A. But the primary question today is really, how do we determine the stock market's outlook based on the recent news events? And for that, what we're really going to do is turn to our charts. So today, what I'm going to share with you are my technical charts, what I saw prior to this news, and how markets have reacted to that to give us a better understanding as to what is likely going to happen in the future. We're going to take a look at everything from economic news to the payrolls numbers and all of that in order to give us a better sense. So we start off by looking at the S&P 500. Now, the first thing I want to point out here is even prior to the news, the S&P 500 failed to get back to those prior highs, which was the 342. These prior highs were the highs that were put in after the initial plunge. We put in 342, we tested 342 multiple times. And the S&P 500 yesterday, over the past couple of weeks, on relatively strong news that things were stabilizing in terms of COVID, in terms of consumer spending numbers continuing to be fairly strong, failed to get back to the 342 level. That is concerning to me, because if we can't get back above 342, we really cannot continue a bullish trend here in the market. So what that means is that this bullish trend here so far has still pretty much been neutralized, and we are still back into this neutral zone. Now, based on this morning's news, we're back square into this neutral zone, and we're likely going to retest that 323 level here to the downside. So within this 323, 342 level, we're very much in a bullish a neutral zone here in terms of the equity markets. So the question is really how markets are going to react today. We'll have to see after the open. Overnight, markets were down about 1.3, 1.4%. Not a big move, in my opinion, considering the size of the news. But we're starting to trade a little bit lower now on the payrolls numbers that came out about half an hour ago. So market's starting to react a little bit more to the negative, but down less than 2% from my perspective in the current volatility, in the current volatile market that we see is not a particularly strong reaction. Granted, this is pre-market. We could see continued sell-off during the trading session. So that's what we're watching very closely here today. If we open up and markets continue to accelerate to the downside, or do we open up around 2% and then stay around there for the day? But overall, down 2%, not a big, huge move in my opinion for the S&P. If we look at the NASDAQ did yesterday manage to make it all the way back up to those prior highs at 282. But yesterday, intraday, failed at those levels, tried to push through that level multiple times yesterday, around 12 o'clock, around 2 p.m., but both times failed. And what we have now is on the news, a negative reaction here to the downside. So the Q is starting to move a little lower, over 2%. But again, on the NASDAQ, 2% move is not, in my opinion, a huge move, not a big reaction. Partially, I think it's because, granted this is big news, but there have been other world leaders that have contracted the coronavirus, that have moved past it, and largely have become a non-event. So markets, not at this point overreacting at this moment, in my opinion. Certainly not down 4 or 5%, and I think that's particularly good, and speaks to more of the resilience, if you will, of this market. And I think the market wants to try to break out here, but so far hasn't been able to. But it's interesting that it did fail at that 282 level, and it's now starting to move lower. So very interesting to see how markets react going forward. So those are the key levels of the S&P, the Qs. If we look at the Dow is substantially weaker than the S&P and the Qs yesterday. So we're also interested in seeing how that plays out. But small caps, we've mentioned here a couple of weeks ago, for the past couple of weeks, that we're in this small downtrend. This is going to continue as it gets rejected at that upper bearish trend line here. We expect this to continue. Small caps has lagged behind. As you can see, money flow has been pretty much weak since the beginning of September. So small caps yesterday showing a little bit of strength, outperforming the S&P and the NASDAQ 100, but now down over 2% here pre-market. So both small caps and equal weight, very similar chart. You have the similar downtrend here, and what we're going to likely see is equal weight move lower here today as well. So overall, markets in a neutral tone, slightly bearish here this morning, but it's important to see how markets react to the news here today. Now, when we look at GLD, GLD managed to, after breaking down below that 180 level, which is a major support level, trade all the way back up to that 180 level. And I believe gold pre-market here is up actually a little bit here today. This is a bit of a risk off, I would say, measure here, where people are buying gold as a flight to safety, perhaps selling some equities, buying some gold. So we could see gold reclaim this 180 level here today. I did say earlier this week that I thought perhaps this was potentially a buying opportunity for gold. If we do get above 180, that certainly cements that continuation of a potentially bullish trend here for gold, despite dollar looking fairly strong and strengthening here over the past couple of weeks. We're still continuing to see gold strengthen here. So this is one that I'm paying attention to here as it retests that 180 level and see if it can break back above it. If it fails at that level, then we are likely to continue to see further declines here for gold. When we look at crude, crude is continuing its collapse. This has been driving energy shares lower. This is the only sector that was down over 3% yesterday, while the markets were up, well over 1.5%, depending on which index you were looking at. So if you look at the longer term trend here for crude certainly continues to trade below that $42 resistance level. This is the 200-day moving average here on this chart, as you can see, continuing to provide downside resistance here, and gold and crude continuing to move lower here. This is particularly what I think is going to lead to further losses here in XLE. So for those of you asking, is it time to start buying XLE or oil stocks? I've been getting a lot of those questions over the past couple of weeks. From my perspective, I don't think it's time yet. I think there's further downside to some of these names. I think you're likely to see more bankruptcies, more mergers in this particular space. I don't think this is a bottom yet for oil. When we look at treasuries, this is really where we've seen a strong bid for treasuries this morning. And this is not surprising, again, as the news from this morning will likely continue to spark this risk-off environment where people have this flight to safety into gold, into treasuries, and out of things like high yield. So treasuries continuing to catch a bid here. But HYG yesterday, we talked about this last week. HYG, which is the high yield fixed income ETF. This is an ETF that the Fed is actually outright buying. Now, we've never had the Fed outright buy ETFs before, but this is one that the Fed has been buying, and in the $84 level has held for quite some time, but it also has been a major resistance level for quite some time. But it finally broke below that last week, and this speaks to, from my perspective, a little bit of softness from fixed income investors into higher yield, higher risk products. And we're seeing that outflow out of high yield last week. We've retested that $84 resistance, and now we're being rejected off of that yesterday, and this is likely going to continue today. So this is the fixed income markets telling us a little bit about how they're positioning, risk, how they're viewing the risk on, risk off environment. As you see outflows from HYG into TLT, this is telling me that fixed income markets are positioning for more of a risk off environment in the current market environment. So big news is the fact that payrolls came out this morning at 8:30 a.m. substantially lower than expected. This is really what's driven a lot of the gains, in my opinion, over the past few months, because the payroll numbers have continued to surprise to the upside, both the number of added jobs as well as unemployment. Unemployment did come in better than expected at 7.9% versus the estimated at 8.2%. But over the past few weeks, we've talked a little bit about, the unemployment rate and how it's calculated. And I don't think that this is, I don't put as much weight behind the unemployment numbers as I do behind the non-farm payrolls, which were expected to be about 800,000. Some estimates were even a little higher than that, close to 850,000, but we came in at 661, so substantially lower than expected. And this is what we are seeing from the high frequency indicator. We're seeing that employment gains are continuing to erode. They're slowing down substantially. This is for September. We're likely going to see the rest of the year continue to be slower as unemployment claims continue to be very high here on this front. So this is one of the concerns that we have with the shape of the recovery. So far, for the most part, when we look at most economic indicators, especially on the consumer spending side, especially on the employment side, even if we look at the stock market as a gauge for the recovery, largely we have had this V-shaped recovery, but this is starting to slow down a little, and whether or not this V-shaped recovery is slowing down, we certainly know that it's slowing down. The question is whether it's going to start reversing lower or just continue slowing down. But regardless, this is one of the reasons that markets drove a little lower, even though we were down about 1.2, 1.3% pre-market before this news. Now we're down close to 2% on this news. So certainly equity markets reacting to this as well. So to balance that, the one thing that I do think that the markets had some optimism this week on, that drove the gains that we saw this week, was really the continued news cycle of movement, if you will, on the next stimulus bill. Granted, we didn't have any particularly great news, but there was certainly movement. There were discussions behind the scenes between Democrats and Republicans. Republicans tried to, in Senate, pass a bill of $650 billion. That obviously is going to be shut down in the House because Democrats think that's too little. The Democrats yesterday passed a $2.2 trillion bill in the Congress. That's likely going to get shut down by the Senate and by the Republicans. So we have this kind of back and forth. While we have not made any progress, the fact that there is this movement in the background, I think, is what's driving some of the optimism here in this market. But it's becoming less and less likely that we are going to see a stimulus bill before the election and maybe into next year. So this is something that we will discuss during our election special next week, because this is a big part of what can potentially drive these markets higher. All of those resistance levels I was referring to on the S&P and the NASDAQ 100, in my opinion, you need to have some form of stimulus. Even a skinny stimulus bill could be what we need, or the catalyst that we need to get markets to resume that bullish trend. Without it, I find it more and more difficult, especially as time goes on and we continue to see erosion in employment, erosion in income. So we just got consumer spending numbers yesterday that were particularly strong, but personal income fell. This is the part that's going to be a concern for consumer spending numbers, because if we look at consumer spending, one of the things that you see is that there are plenty of categories that continue to see strong spending on home improvement, on online electronics. You know, these categories are likely going to start declining as income levels start to fall, and stimulus is not there to offset that loss of income, because we still have certain industries like entertainment, airlines, lodging that are going to continue to see declines. Now, the one thing about this is that the airlines have a fair amount of federal stimulus, if you will, or federal support for those industries. But if you look at lodging, lodging is not the industry that has been getting any type of government support on that front. So lodging is actually one of the sectors that we see quite a bit of weakness going forward, especially as we see, you know, whether you're looking at some of the Las Vegas Sands ideas that we threw out earlier this week, or if you even look at the major hotel brands like Hilton, Marriott, these types of names, these are likely names that are going to continue to underperform, because we continue to see strong declines in terms of consumer spending in these particular spaces without any type of federal or support for these types of industries, with the exception of airlines, which does have support of federal industries, federal support, which is likely going to at least keep them afloat and unlikely to go bankrupt from that perspective. So payrolls and consumer spending, extremely important for us to pay attention to. Consumer confidence actually continues to improve a little bit to the upside. So this is something that is positive, and this is driving, in my opinion, the optimism that we're seeing here in this market, is the fact that consumer confidence continues to improve, and 70% of the US GDP is driven by consumer spending. So if consumers are confident, they're likely to going to continue spending. This is one of the indicators that the high frequency indicators that we are paying attention to. We have seen surprises to the upside this month. Let's see if that continues into next month. But with the rising number of coronavirus cases, I think that this is likely going to see some declines or some plateauing, if you will, in some of the consumer spending numbers. Consumer confidence numbers, because a lot of the gains in consumer confidence was particularly driven by the declines in the number of new cases and the number of deaths. We have had a significant rise in cases over the past few weeks. Deaths have not increased, but cases have. So the question is whether or not this is going to take a dent here in consumer confidence. My take is that this is unlikely going to be a big second wave. This might be a smaller second wave, and is likely going to be contained, and we might see deaths continue to trend lower. As long as deaths continue to trend lower, I think it's okay to see a small uptick, especially as if it starts to plateau. I think markets will be okay with that type of data set, if you will. Now, while the US has obviously had this huge second wave that has now slowly started to decrease despite the small increase we've seen recently, Europe is a completely different story. As you can see, Europe is on a very strong trajectory up to the upside. If we look at Spain, France, the UK, we continue to see strong uptrends here in the European countries. Those countries have not locked down their states despite these rising cases. So we do think that the European economy, while is going to suffer from this, is unlikely going to have the same effects as a full lockdown. So this is we do expect to see some weakness to come out of Europe, but not particularly strong unless cases get worse and they do go into lockdown. So that is a risk that we currently see with Europe and some of the developing markets. Last Friday, we took a look at the developing markets and the equity markets there. They have not been looking particularly strong. So that is one of the concerns that I also have from a global equities perspective is the fact that most of the developed countries looking fairly weak. Most of them have broken below some major support levels. The relative strength on those markets are fairly weak. That is a concern to me. So with that, to take a look at some of the ideas that we currently see, we really want to take a little bit more of a longer term, slightly more defensive view here, looking at what sectors have provided a bit of defense. We're seeing some rotation into. Industrials remain one of those sectors that we see some rotation into. And this is why I still continue to like FCX, which is one of the largest copper miners. Copper did take a hit this week, and I do think that the decline in prices for copper and the decline we've seen in FCX provides an opportunity to potentially get into a long position as it pulls back to support. I will say that at this point, it is difficult to look for potential opportunities given the news cycle right now, because a lot of things can change in the next few weeks. But this pulling back to this 15 level here on FCX, in my opinion, a huge breakout level here, this is a rare opportunity for a strong breakout to pull back to its support level and potentially play for a longer term upside here. So this is really the daily chart. We've gotten the pullback here. We're back into that 15-20 range. I think this could be a potential opportunity. What I like about this particular setup is the fact that you don't have to take on a lot of risk, because if FCX gets back below 15 into the 14s, I would cut my losses and move on. I'm risking only about $1 to the downside on the underlying stock, and I'm looking at least 3 to 4 to the upside. So the risk to reward ratio on this particular trade, in my opinion, looks fairly attractive. We do have to, again, balance it with what we see in the news cycle here today. If markets open up and start accelerating to the downside, I would wait on any of these long trades, if you will. But if markets stabilize, down less than 2%, in my opinion, not a huge reaction to the current news. Same thing here for Walmart. I think Walmart's is a fundamentally a stock that I like here. We've gotten that initial rally off of that. We talked about this on Tuesday. If you missed that, we have a pullback here back to the breakout level. So again, risk reward ratio, in my opinion, here looks fairly attractive, because if Walmart gets back into the 136, 135 range, I would cut my losses and move on, but there's still a fair amount of upside here on a name like Walmart, especially in the long run. This is much of a longer term view, because especially in the light of such market moving news, we want to take longer term views rather than short term views here in this market. Short term views you can, but you have to be very nimble depending on the news cycle. On the flip side, this is XLE, not XLRE. I apologize for the typo here, but XLE, we talked about this breakdown here below this $34 level a couple of weeks ago. After retesting that support level as resistance, it got rejected and is continuing to move lower. We are now continuing to break down through some new support levels here. This is why I think XLE will continue to move lower here to the downside, which is aligned with the crude chart that I showed you here before. A lot of movement here in the energy space. We continue to see energy companies likely going to, a few energy companies likely going to go bankrupt. We see some deals in the energy space as companies trying to merge or to strengthen their balance sheets by merging with other companies. That's what we're seeing in the energy market. So I think that there's further downside here for energy. So for those of you asking those questions, is it time to buy energy? Is it time to buy calls? Is it time to buy leaps? I think that day will come, but I don't think we're there yet. And again, I apologize for this is Cigna. CI is the symbol, not XLF. And I wanted to take a look at Cigna because Cigna recently broke down below a major support level at 170. We know healthcare has been underperforming the S&P. It has continued to rotate out of healthcare. It is one of the weakening sectors. So after breaking down below this 170 level, we managed to make it all the way back up to that resistance level. And just yesterday, we got rejected at that level. So I think that Cigna can see some further weakness here to the downside. So right now, what we're taking is a very balanced view to the markets. We're taking almost an equal look at longs versus shorts, especially in this neutral market environment that we're talking about with the S&P and the NASDAQ 100. We're taking a balanced approach to the markets. We're seeking strong stocks that are likely going to outperform and weak stocks that are likely going to underperform. We're taking an equal weight on this too because of that neutral view. If markets start to break down, we will shift more to that bearish view. If markets break back above that resistance level that I was referring to, 282 on the Qs, 343 on SPY, then we would get back into more of a bullish view and taking a look at more bullish opportunities. So with that, that covers what I wanted to share with you. Like I said, that next Friday, what we're going to do is an election special. A lot of questions on that front. So I hope that you guys consider joining us as members, because that will be a members only webinar. We will not be doing the regular Friday morning market outlook session next week because we're doing this members only webinar. So if you're on a free trial, please consider supporting us by becoming a member at trade.optionsplay.com/member. If you are not on a free trial, if you're just starting out, you can sign up for a free trial at optionsplay.com. If you sign up for a free trial, you'll be able to get the invite to that election special here next Friday. So sign up at optionsplay.com. So with that, that covers what I wanted to share with you here. Looks like markets, earlier we're pushing almost 2% to the downside here on the S&P. The NASDAQ was pushing a little over 2%, almost 2.5%. Looks like it's recovering a little bit here as we spoke, as we're about to open up here a few minutes into the open. So like I said, while this is certainly bad news for the market between what we had with the coronavirus and the president and the payrolls numbers that came out worse than expected, markets have largely stabilized, in my opinion, prior to the open. The S&P 500 did have a prior low here around 131. It's interesting to see if markets open up and start pushing those lows and fills this gap down to 329. I think that that is a possibility here intraday. If we fill that gap and continue to move lower, then we're headed down to 323 to the downside. But for now, it's holding that 331.50 level. So we'll have to take a look at here how markets react here at this morning. I think it'll be very important to see how markets react. So with that, I want to thank everyone for taking the time out here this morning. I hope that you guys find this useful in helping you start your day and understanding where to currently look as far as the market outlook with the news cycle that we have this morning. Thank you so much. Have a great trading day, and I'll see you guys later this evening on CNBC.